Liberty Kenya Holdings has completed its exit from Heritage Insurance Tanzania. Now, the move comes as the group is preparing to launch fully digital life insurance solutions as a first part of many other products that are aimed at trying to drive growth in a market where insurance penetration remains pretty low at around 3%, and trust in the insurance industry as a whole is still quite fragile. Earlier on, I spoke to Kieran, Godden, who's now the Group CEO at Liberty Kenya Holdings. We started our conversation by exploring the rationale for the sale of that insurance business in Tanzania.
So the core rationale was really around strategic focus. So we're not retreating from different parts of the market. What we're doing is we're concentrating our strategic focus on Kenya. Yes, it freed up some capital, and to make our business more capital efficient, we returned that capital to the shareholders. So what that gave us was a more capital efficient business, which improves our return on equity, which is great for all of our shareholders. And obviously there was a cash payment into the shareholders, but the real change comes for us focusing on our core markets, and our core market being Kenya in this case, and which means that we can put more focus into things like getting our digital insurance platform launched.
Did all the proceeds from the sale go back to shareholders, or is some of that capital being deployed into things like what you said, the digital insurance platform, building that up and scaling it out?
So we returned all of the capital we received from the Tanzania operation out to shareholders. So we fully returned it to shareholders. But that capital efficiency we gained is actually in an indirect way freed up other capital for us to invest. But we are investing our own capital. So we're not asking shareholders for more money. We're investing capital that we have into transforming our business into a more digital operation.
Looking at the half-year results, you pointed out that the Tanzania sale ended up with a commercial deficit of around 28 or so million shillings, relatively marginal. But was that because of the state of the business, the wider the wider state rather, of the Tanzanian economy, or is it just a tough asset to sell in a comparatively tough market?
I think some of it was really just around the nuances of accounting. So there was some kind of technical accounting that needed to be done that led to that negative sort of appearing in the accounts. In the short term, the business did over the interim period. The business in Tanzania didn't make money, and we disclosed that. So it actually lost money over that period. But that's really a short-term problem. So whether it made money or lost money was not so much what we were worried about. What we were focusing on was the long-term strategy, which was around the focus into the cooperating market.
Indeed. One of the things that you cited, in talking about the decline in earnings, especially for the first half of 2025, were these higher claims coming through from general insurance, especially in the medical segment. Just speaking about it in a broader sense, though, looking at the data for last year, we saw medical insurance premiums for the industry as a whole go up by around 15% in the same year that SHA premiums kicked in. Are we seeing that growth continue in 2025 with individuals and companies saying, despite the high deductions for SHA, I'm going to stick with having this private medical insurance option?
Our view is that it does create an opportunity. We are seeing medical continue to grow. We've seen medical continue to grow this year. We predict medical will continue to grow into the future. The two, I think, don't work opposite to one another. The state health insurance, or the SHA, and the private medical insurance complement one another. I think the most successful models around the world work on that basis. And also, that partnership actually works around the hospitals, around what benefits are covered. There will likely be some changes coming through the market in the future, but we still think medical insurance presents a great growth opportunity for the next few years.
How then do we tackle the loss ratio problem? Because looking at last year's data, again, across the industry, not specific to Liberty, but the loss ratio last year was around 78%, which was nearly 400 basis points higher than where it was in Q4 2021, in the middle of the COVID-19 pandemic. That number seems to go up year after year. What's going on with loss ratios in the medical insurance space?
I think there is a difference between what the industry data is showing and what we're seeing. So as you said earlier, our medical loss ratio has ticked up in this year. So we are seeing that. I think across the industry, what happens is there is competitive pressure on companies to keep their business. So what ends up happening is people might price lower than they should be to cover the risk that they have, which then leads back to that trust problem around claims not being paid. Because if you're underpricing your risk, you can't afford to cover it, then the claims loss ratio ticks up. If we think about 78%, it's probably on the extreme upper end of what should be happening in the medical insurance business. Once it starts going above that, I think companies who are running higher than 78, anywhere in the 80s, possibly even the 90s, would be worried because they're burning their shareholders' money to provide the cover.